Hi everyone, in this video I'll be discussing about lending and borrowing in DeFi. But before that, let's get to know what lending and borrowing actually is. So, lending involves the act of allowing an individual, or it could even be an organization like a bank, to utilize your funds which you might have lent as you had them in surplus. And in exchange of that, you can be compensated with some incentive, which is usually in the form of interest. On the other hand, if we talk about borrowing, it's when you receive a loan from another party with a promise of returning it back at a specific time. So, in exchange of this, you're required to give a collateral, which is basically acting as a security against a loan, and you're also required to pay interest along with the repayment. So, in order to explain this better, let's just take an example of home loans. So, imagine you want to purchase a home, but you don't have the entire amount upfront. So, in this scenario, what you can do is approach a bank for a home loan. So, the bank lends you the money needed to buy the house. In this case, they are the lender and they earn interest on the loan amount. As the borrower, you receive the loan to buy the home, and the house would act as a collateral in order to secure the loan. So, over time, you're also required to repay the borrowed amount with the added interest. Now, in the traditional banking system, the way lending and borrowing works is that when you have an account in a bank and you deposit funds in it, the bank can utilize those funds in multiple ways. Like they could invest it somewhere, or they can even offer them in the form of loans to borrowers. So, in exchange of that, lenders will receive interest. Now, the way it works is that, for instance, you have around $10,000 in your bank account. You might be earning 1% interest, while the bank may be charging around 5% interest to borrowers. So, in this case, the bank's revenue is the 4% interest spread. Next up, trust based system. So, the banks operate under a trust based system, which basically means that they don't provide loans to everyone. Instead, they check the credit scores of the borrowers in order to make sure that they will be able to repay the debt. Imagine there's one person who has a good salary but has no loan history, and then there's another individual who's earning less but has been able to successfully repay past loans. So the bank might favor the second person because they've shown they can handle borrowing responsibly. Other than that, there are different types of loans like short term, long term. So the repayment period ranges from around 1 to 7 years. Regarding the fee structure, it's pretty vast as there are a variety of fees required to be paid. For instance, at the time of applying for a loan or when the loan is sanctioned, and even in the case where you make a late payment, you need to pay a penalty fee as well. There could be hidden fees too, so it's important to be aware of all the costs involved. There's a lot of check and balance in the case of traditional banks since they follow a centralized approach, which is actually good because the government makes sure that the banks are reliable. Fractional reserves, it's basically the practice where banks only hold a fraction of the customer deposits in reserve and they lend out the rest. So the system allows banks to create money through the process of lending, but it is quite risky as well. So let's take the example of Silicon Valley Bank. In March 2023, basically the bank collapsed. And the reason was that they had invested in long term bonds, and due to the shift in interest rates, they faced losses. So, when the depositors rushed to withdraw their funds, the bank just couldn't meet the demand due to its fractional reserve system. Other than that, the banks also lack innovation. Like they've been acting on more or less the same principles and workings without too many changes in the last 10 or so years. In the case of DeFi, it functions differently because it makes use of blockchain. So, a smart contract in blockchain has a unique wallet address that serves as an account number, and lenders they can easily send funds to the smart contract address, and then borrowers can obtain loans from this address. But it has its own drawbacks as well. Since the DeFi industry is fairly new, there is always a risk of smart contract hacks and bugs due to which people can also end up losing their funds. As it is decentralized in nature, so all the data is available to be viewed on the blockchain. Liquidity pools. So, like when you lend funds in DeFi, you're basically depositing them in pools, and it depends on the DeFi protocol itself. Like some of them might have a single pool for the entire platform, or they could even have separate ones based on the type of assets. Over collateralized loans. So in DeFi, they focus on the concept of over collateralization, which basically means that the value of your collateral, it should be higher than the value of the loan. Next up, we have liquidation process. So at the time of liquidation, as the borrower is insolvent, so liquidators are the ones who pay off the debt on behalf of the borrower, and in return, they basically get an incentive for doing so. Interest distribution. After the platform fees is deducted, in case there is any, the interest received from borrowers, it is then distributed among all the lenders. Lastly, we have incentivization. So, in order to promote a particular side, or it could even be for the overall growth of the platform, they may choose to incentivize lenders, borrowers, or even both as well. But definitely, there are risks for over incentivization as well, because people might not only be active just to participate, but also solely to earn rewards, which basically means their lack of commitment. It could affect the platform's long term sustainability as well. One of the top DeFi lending and borrowing protocols is actually Compound, which has offered more than $875 million of borrowing, backed up by more than $2 billion of collateral as of January 2024. So basically, in Compound V3, there are separate markets with a base token, which is paired with a collateral. And these markets, they are of two types. So one is in which wrapped ETH is the base token, and the other is in which USDC is the base token. The maximum amount that users can borrow in Compound, it is pretty much limited by the collateral factors of the assets that they have supplied. So, for example, like if a user supplies, let's say, 100 DAI as collateral, and the posted collateral factor for DAI is 75%. So then the user can borrow at most 75 DAI worth of other assets at any given time. Lastly, when a borrower becomes insolvent, then the liquidators repay a portion of its outstanding borrow, and in exchange of that, they receive the borrower's collateral at a discounted price in the form of an incentive. Another top DeFi lending and borrowing protocol is AAVE, in which more than $10 billion of liquidity is locked as of January 2024. So when you deposit funds on AAVE, you basically receive A tokens in exchange of it. These are basically interest bearing tokens which are minted and burnt in a 1:1 ratio. And when you decide to redeem your assets, you will need to make sure that the reserve has enough liquidity. And secondly, that the user's health factor is above 1. So the user's health factor is actually denoted by the number 1. And in case like it is greater than 1, then it means that the borrower is in a position where they can repay the debt. But if it's lower or closer to 1, then the liquidation process starts immediately. Lastly, as lenders receive A tokens, in a similar way, borrowers they also receive debt tokens, which are burnt as the debt is paid back by the borrowers. Now, given that DeFi is relatively new within the financial landscape, so it's still evolving in terms of governance and risk management as well. So let's discuss how TradeFi and DeFi are different from each other. Firstly, transparency. Since banks have complicated processes, you can't get hold of detailed information related to the transactions or fund allocations since they are not accessible to the public. But in the case of DeFi, since it makes use of blockchain technology, You can easily track transactions and also how the system operates as well. The eligibility criteria for borrowers also varies, as in TradeFi, the process is very extensive. There's a lot of paperwork and documentation required. Also, sometimes banks make mistakes and give loans to people who can't even pay them back. But in DeFi, anyone can borrow or lend. All you basically need is just a crypto wallet. Collateralization approach. So the concept of over collateralized loans isn't applicable in TradeFi, but it's only applicable in the case of DeFi. Next up, openness. So in TradeFi, open forums for discussions and community involvement are not as common. On the other hand, in DeFi, there are open forums where users can openly discuss and share their thoughts. Rate of returns, which are considerably low in the case of TradeFi, reason being that there are intermediaries involved, but in DeFi, as there is no middleman involved, the rate of return is higher. Lastly, we have regulations. So there are regulatory bodies governing banks for security purpose, as we know, but in DeFi, because it is decentralized, so the data stored on the blockchain, it cannot be changed or tampered. Now you might be wondering, why do people actually lend and borrow in DeFi? Well, there are multiple reasons for doing so. One of which is to earn passive income, which means that if you have funds in surplus, you might want to gain some benefit out of them instead of just keeping them in your wallet. So what you can do is, like, you can lend your cryptocurrency and can make gains through it. Another case is stablecoin borrowing. So, for instance, if someone believes the value of their crypto assets might increase in the future, then they could borrow stablecoins against those assets instead of just selling them. In this way, you can use them to cover your own expenses as well. Then we have liquidations, which again can be quite profitable, especially for tech savvy traders. Usually, liquidators they have to compete against other people for the same job. So what they do is that they use bots instead. In turn, the liquidators receive a reward fee for their services. Lastly, we have marginal trading, which is also called leveraging. In this case, you have the ability to control a larger position in the market with a smaller amount of your own capital. So, this can be achieved through borrowing additional funds. Let's say you have around $1,000 worth of cryptocurrency and you decide to borrow more cryptocurrency worth $4,000. Now, if you invested somewhere, whatever gains you make would be more than what you would have made in case you only used your initial capital, which was just $1,000. Lastly, flash loans. So this concept is pretty different from how lending and borrowing in DeFi normally functions, because flash loans they aren't backed up by a collateral. Like, you can just borrow an asset and return it within a single transaction, which is why it's called block borrows as well. And they're codified by smart contracts, so the transaction only takes place if the terms and conditions of the contract are met. In case a flash loan trade doesn't return the full amount of liquidity to the pool, then the entire transaction will be reversed just to ensure that the funds are safe. So, a good example of this could be like you could use your flash loans in arbitrage trading. So, with a flash loan, you can instantly borrow, let's say, 10 ETH without needing collateral. This speed is important for something like arbitrage, where timing is everything. You need to repay the entire loan plus fees in the same quick transaction. If your trade succeeds, then you can keep the profit. If not, then the transaction is reversed, and your only loss in this case would just be the flash loan fee. So that's all for this video. Thanks for watching.